traders, Gary Wagner here. Currently it is 12:49 in Honolulu, 5:49 in New York on Thursday, January the 6th, 2022, and this is the Daily Report for gold and silver. After 2 days of respectable gains in gold, the release of yesterday's FOMC minutes from December seemed to have a delayed reaction as traders focused and gleaned on what was actually said. The net result was dynamic pressure to the downside, resulting in a decline of $34.20 in gold. That's a 1.87% decline, with February futures currently fixed at $1,790.90. Yesterday, we did pull small profits as we had raised our stops up. We got in at 1801, out at 1808, but when we saw the dip last night, we went and issued a buy signal, a trade alert, to enter the market from the long side. Traders, we got in at $1,788. We'll talk about that in detail when we pull up our charts. Silver had even more selling pressure, losing almost a full dollar, a 97-cent drawdown, 4.19%, with the March contract currently fixed at $22.20. And although the dollar was fractionally higher, the dollar strength really didn't add to today's decline by very much, but we also saw a decline in all of the three major indices, the S&P, the NASDAQ Composite, as well as the Dow. It seems that the minutes that were released yesterday from the December FOMC meeting contained information previously not factored into any of the markets, and on top of that list is the fact that they talked about their reduction after they end the tapering process to lessen their balance sheet of assets, which is now north of $8 trillion. Just prior to the New York Open this morning, we did send out a trade alert recommending the initiation of long positions in both Forex and February gold futures. Our entry price was $1787.60. That's marked right here. Very, very close to the bottom of the range. And in fact, after the trade alert was sent out, we did have the market run up, only to come back down at just about current pricing, which is $1,790.80. We also recommended placing a stop at 1772 that covers this open right here, and really a series of bottoms that were really supportive of that price point back about a month ago. Our recommendation is to maintain your current long positions and to maintain your current stop. We are looking at a short-term candlestick chart. Each candle represents 10 minutes of trading. You can see the beginning of the day. That's marked by the number 6 right here. And that is when we sent out that trade alert during this period of time here. Easily we can see that the market did run up immediately following that. It traded to the high of the day, but then it had a methodical decline, first fairly steep, taking us through the first couple of hours, and then very, very narrow and defined price range as we went in throughout the close. We are currently trading overseas, and as I said, we're up about 20 cents from the close in New York. My feeling is that the reaction today to the minutes released yesterday were quite exaggerated. They, I believe, were for a large part based upon the fact that for the first time, the Federal Reserve not only spoke about tapering, which they have been adamant about beginning that process for months and then accelerating it, but asset reduction. I draw your attention to the chart that I've just put up on the screen. It was done by Reuters News Service, and what you can see is that during the first time they did quantitative easing, this was back when Ben Bernanke was chairman of the Fed, the balance in their accumulation of assets were just under $1 trillion. And within a few years, it swelled up to $4.5 trillion. Then they began to reduce the assets in their balance sheet. And when they got to about $3.7 trillion, Chairman Bernanke came out and he said a further reduction would be detrimental to the economic recovery which was taking place following the recession that began in 2009. Although the tapering process and taking the purchases to a net zero will be accomplished fairly easily, a reduction of the balance sheet will present a whole new set of problems similar to the ones Ben Bernanke faced during the last recession. It is for that reason that I question that they'll be able to reduce the balance sheet by any great amount of money. The fact that the minutes reflected the desire to reduce their balance sheet will have to be detailed and clarified in the upcoming FOMC meeting. But prior to that will be tomorrow's jobs report that are expecting fairly strong numbers and I believe are currently factored into current pricing. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.